Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hey audience and listeners, this is James Kandasamy from Achieve Wealth through Value-Add Real Estate Investing Podcast. Today, I'm happy to get Ivan Barratt into our show. Ivan is a multifamily owner, manager, syndicator who specializes in large apartment complex in the Midwest. And he has been doing it since 2015 with over $80 million in equity, with more than 3,000 units as the primary GP. And he has grown his company, which is Barratt Asset Management, to be best in class, two-time Inc. 5,000 private equity and management firm. And he focuses a lot on equity finance, acquisitions, and company strategy. So currently managing over 300 million in assets, comprise almost 3,500 units. Hey, Ivan, welcome to the show.
James, so good to see you, dude. I always love talking to you, man. It's good to be on the show officially.
Absolutely. I know we postponed it a few times, so this is going to be very, very valuable to me and to my listeners as well. So Ivan, let's get started. I mean, I'm trying to avoid like, how did you get started, right? Because I don't want to be taking up too much time. But let's quickly go through it. How did you get started, and how did you end up with $300 million in assets under management?
Yeah, for me, it all started with one duplex that I house hacked. Back in 2000. I'd wanted to be in real estate my whole life. My dad's in real estate. He was an attorney, always owned rental properties on the side. A couple of entrepreneurial uncles on both sides of my family that owned apartments, gas stations, car washes, all kinds of businesses. So at a really early age, I wanted to be an entrepreneur, and I wanted real estate because I thought, gosh, why would I want a real job when I could just go out, own a lot of property and do whatever I want and watch the rent checks just come in. So went to college, went through business school, got a degree in real estate finance, got out, house hacked a duplex. For the first 8 years, I worked for a mentor in mostly development, but also property, asset management, all kinds of different jobs hats that I got to wear working for this real estate developer. And most importantly, I got a front row seat to the great financial crash of 2008. So at a really young age, huge gift, learned I wasn't as smart as I thought I was, learned that I was doing real estate the wrong way. And that's when I really started modeling multifamily companies, because I had always wanted to own apartments, but I also saw that in a downturn, those multifamily companies got bigger, they got stronger. They acquired more assets because of the way they were financed. And so that really was the impetus to get me started in my own pursuits. BAM actually started in 2010 as a property management company first, because I knew that if I could figure out the property management game and doing that for others, that when it was time to buy bigger deals for myself, I would have a higher likelihood of success, of execution. So I started buying a few small deals at the same time, was managing for other clients, anything I could get my hands on where I didn't have to carry a gun, and I was doing everything. Started from the bottom and started being able to buy larger apartment deals. And when I say large, I mean my first apartment deal was 6 units. Then I bought 35 and a 30. Then I said I'd never do another small deal again, and I bought 15 because it was just too good to pass up. And then from there, I started syndicating. I did my first syndication of 60 units, then I bought 112. And all the while still managing for other people as well. That was really how we grew the company in those early days. Once we got to on-site staff size properties, there was really no turning back. It's pretty addictive. Fast forward to today, we still do some management for others, but we mostly manage our own assets now, and we're far and above our biggest client. And that's the shorter version of where I come from and how I got here.
Got it. So is this 3,500 units? Is it all you? I mean, your company, or you guys do fee manage part of it, or how is that?
Yeah, so I own about 3,000 units. We're down to about 500 units we manage for others. It's not really a focus moving forward. We still have a few close partnerships that we like managing for. But really, the way I've built and designed my company is not to be a profit center of property management, more to be an execution machine for my own wealth strategy. I think you and I have talked about this before. On the property management side, I could be Scrooge and I could really be tight and I could probably make a 15% margin, but instead we focus those dollars into our culture, our people, growing leaders within the organization, having fun. Property management's not easy, having great events, and really trying to create this beautiful machine of people that want to come to work, want to do a good job, want to stick around a while, and believe in what we're doing. We call it the BAM fam.
Awesome. So let's go deep into the, how you got started, and it's just so interesting, right? I mean, you started, you had that vision to start from property management first, right, rather than owning assets, which is, how even Ken McElroy started, right? He started being a property manager first, and then
Ken McElroy was a huge influence in my career. Yeah, huge influence. I read his book very early on, and that was one of the key influences for starting my management company and figuring that out first.
Yeah. And I think he have mentioned it many times. I mean, for audience who doesn't know who's Ken McElroy, is one of the big, largest owner of multifamily in the US. I mean, he is advisor to Robert Kiyosaki, and he's a big guy, well-known guy, well-respected guy in the multifamily industry. And he mentioned very clearly in his book, right? I mean, to get started, you probably want to work for someone or go and work as a property manager. And I do not know I don't think so many people are following it, because people think it's just buying assets and letting it ride through. It's okay. But what did you learn from that experience, starting from property management and going into an owner as well?
As a small, I've got, this is 2011, 2012. I've got 70 units, and I am everything. I'm the bus boy, the cook, the maitre d'. I'm the leasing agent. I'm the property manager. I'm the the rent collector. I had a little bookkeeper that came in every other week because I didn't want to screw that up. So I literally did everything first and learned to be efficient with it, and also learned, strengths and weaknesses, and made a lot of mistakes. I finally just decided early on that I knew I was going to make a lot of mistakes, and that was just part of it. I finally figured that out in my mid-20s, that being an entrepreneur is a lot about failing forward, making mistakes, and learning from those mistakes and not quitting. It's not a complicated sort of method, but it's the backstory to a lot of successful entrepreneurs. So I just copied what those who had been there before me had done.
Got it. And I mentioned it in my book. Across all commercial real estate, multifamily is a really, really good asset class. But the hardest part in multifamily is property management. Managing that 300 or 100 units income stream from different people is just the hardest. I mean, you'd rather buy an office and have 3 tenants, professional tenants, right? And you're done, right?
Yeah. Multifamily is the best asset class for return on investment on the planet until you move in the people.
Yeah, until you move into the the hard job of multifamily, which is basically the property management itself. And you figured it out. You figured out beginning itself that property managers. I mean, you want to start from property management and go into asset management, right? So, but now, I mean, even now, you and I know that you really don't make money in property management, right? It's basically a time-consuming job, right? So,
the most important one, but very time-consuming. The most important job.
Yeah, absolutely. The most important. And we do it for control, right? For control of our value.
Oh, absolutely. I couldn't imagine hiring a third-party manager for my own assets. It's just the way we do things and the amount of control we have, the ability to move pieces around. For instance, we had one property that was suffering a little bit. We were still trying to get the right management team in place. We took our best leasing agent in the entire company, and we moved her across the state to do her thing at an asset that needed her assistance. That's very easily done when you control the management side of it. If you're out there and you're just another number to a third party company, that's a far more difficult solution to get, right? They're not necessarily going to give you their best people or move around their best people.
Yeah. And I also think property management is the best way to make deals numbers work in this market cycle, right? Where, the market is not like appreciating like what it used to be in the past 5 years. And
You're giving away my best secrets, James.
I know you can't.
How we get our value add picture to work is a big part of it is being able to manage these units efficiently and knowing exactly what it's going to cost to run them and finding inefficiencies and reducing expenses. That's not it's one of the three legs on the stool right now for making deals achieve target returns. No question.
Absolutely, absolutely. And I think that's very important for, that's why we do vertical integration, right? Because, if you want to do deals at this stage of market cycle where everything is, overpaid and, people are bidding for high prices for everything, it's just so hard to make, if you're doing a third party, right? So
no question.
So yeah, I mean, to be frank with you, in the last 1 month, I have like four friends who are syndicators who never had never had their own property management company. They called me for a meeting. They said, "Hey, how can we do our own property management company?" And I asked why, and they said, "Oh, all these guys are not good. All this third party." What I told you guys like 2 years ago, right? And well, I said, "Do not do it," but they said, "No, we're going to do it," right? So I mean, yeah, if the market is 150% and your property management is 70% capable and market's 150%, your property management company capabilities are masked off by the market, right? So, but if it's the other way around, right now, I don't think the market's at 150%, probably is 90, 80%, right? But now, everybody's getting undressed on how capable they are. And now everybody's like, scrambling to go and say, now they're seeing all the weakness of all the third party property management companies, right? So
I agree.
Yeah, absolutely, absolutely. So come back to deals that you buy, right, in Midwest, right? So is it you are in Midwest, and is that why you buy in that market?
Well, I'm lucky. I live in a place that's really great to invest in right now. Midwest, it's steady. The markets we look at have been growing on average 3% a year for 35 years. They don't boom, but they don't bust either. And so we like a lot of these tertiary and secondary markets in the Midwest that have also successfully decoupled from the Rust Belt economies of old and have government, education, healthcare is big. There's some blooming in the tech space, R&D. There's some big insurance companies, financial services. So there's these markets like Indy is a great example that haven't quite seen the boom that some other markets have, but they've just continued to steadily grow, which is really good on a 5 to 7 year hold period if you can find the right assets inside those markets.
Yeah, Midwest, I'm not sure where I read it, but it's actually like the whole Midwest is very stable in terms of economy.
Yeah, it really has become that way. And also in the B plus rental cohort, the percentage of rent to income is still in the mid to high 20% range versus a lot of hotter markets where it's higher than that. So I would see that as a sign that there's still room to grow rents if you're good at picking growing submarkets within those markets.
Got it. Yeah, if you're able to identify the submarkets within that submarket, within the market itself, you'll be
the submarket within the submarket within the submarket, right?
Well, that's what real estate is, right?
Yeah, hyper local.
Hyper local, yeah. And I'm sure you being local, you would be able to know a lot of areas on your own, and you'll be able to figure out things. So, what are the states that are you investing right now in Midwest? Or is it more like cities?
No, so far we're in Indiana, Ohio, Illinois. Okay. We've got lots of submarkets in these areas that we are targeting. And then from there, there's certainly other states we've got our eye on here in the Midwest as well.
So the deals that you are getting from this Midwest, is it through brokers, or how are you guys through relationship, or how is that?
We're at our level. So our typical deal is going to be somewhere in the $30 to $40 million range.
Okay.
And all those assets are controlled by the brokers. If you try to circumvent them and start going direct to sellers, they're really not going to keep you on their deal flow list. So we use the brokers to our advantage, and we get a lot of off-market deal flow from our beloved brokers. We've closed a lot of transactions with them. They know we're a great company to do business with. We never retrade. We close quick. And so we end up being on the short list when they've got a seller that may be willing to transact, but doesn't necessarily want to go full bore on market.
Got it. Got it. So let's say today a broker sent you a deal. What would you look for in that deal that, may be attractive for you?
Yeah, so we're looking for newer assets that are late 90s, early 2000s. We like some stability because our fund dictates that the property can pay monthly cash flow to the LPs starting within 30 days of closing. And we like that cash flow to be current to the preferred return of 7%. So it's got to have cash flow day one. And then we still want to see some upside from value add, bringing in our management team, like you and I just spoke of, to manage it more efficiently, but also to make some improvements. If it's mid 90s, it likely can stand some amenity upgrades and some cosmetic upgrades to the units. So we're looking for those two pieces. And then third, we want a market where the rent is still growing. Jobs are coming in. It's a good school district, right? You've got population growth. So those three components, if those add up to a reasonable expectation of 15, 16, 17, 18% IRR on a 5 to 7 year hold, we like it. We underwrite it to a 10. So, if we're holding it more than 7 years, we want to do 2.5 to 3.5x equity multiple net, but we really want to harvest every 5 years if we can.
So how do you determine the exit cap rate? I mean, I know you can't really determine the exit cap rate, right? But in Midwest states, how would you how would you underwrite? What is the market cap rate plus how many?
Yeah, I know that there's a lot of talk right now about exit caps and what makes sense. So we always just provide a cap rate sensitivity analysis. So we show what it looks like if the cap rate goes up every 25 bips. We show what the return looks like. It's our suspicion that cap rates are maybe a little bit lower than they will be over the long run, but not as much as you'd think. The spread right now between the 10-year Treasury, which is at 150 today, actually it's a little less than 150, thanks to the coronavirus, and say a cap rate I'm buying at of 5.5 or 6, you're talking about a 500 basis point spread in some cases. In 2008, when the economy crashed, the spread between the 10-year and commercial cap rates was 50, 75 basis points. So if you think about the spread between what you get for leaving your money in a 10-year bond and what you get for putting your money in a multifamily is still very, very fat. So I don't see that spread going up unless interest rates go up a lot. And there's a growing consensus that interest rates aren't going up anytime soon. The debt would just get too expensive. There's too much deflation and global slowdown in the macro global economy to force rates up. They're actually continuing to have to ease and keep rates down. And so I am certainly in the school of thought that we are going to look much more like Japan over the next decade. We're not going to have a lot of negative GDP, but we're not going to have a lot of positive growth either. So rates will stay fairly low, and there will be demand for risk assets that offer a healthy spread above the 10-year. So that being said, I probably went down a rabbit hole. It's
No.
maybe a little too deep. But with that being said, we're typically looking at 50 basis points on the exit at 5 years, but we don't get too caught up into that. We never show our pie in the sky projections to our investors. We never show what we think the maximum rent we're gonna return is. For example, I just bought a 272 unit deal, fantastic deal I'm excited about, in a submarket called Greenfield, Indiana. It's inside the Indianapolis MSA, third fastest growing county in my state. And I just have been organically raising rents since closing, $150 a door on renewal. And I'm painting and carpeting.
That's awesome.
So I'm not really worried about my exit cap on that deal. You know what I mean?
Yeah,
And the thing is, if cap rates, this is the other reason why you and I get 10-year, 12-year agency debt, is because if there's this point in time where cap rates spike, I'm not selling. I'm going to hold the property in cash flow. Just think about it, James. If cap rates are going up, it's because of inflation. Interest rates are going up to fight inflation. Agree?
Yep, absolutely.
Well, if inflation goes up, rents are going up too. And the best part about apartments is that we get to reset our rents every month and every year. And so if I don't have to sell at this little point in time and I can raise my rents and wait for things to stabilize and cash flow along the way, I shouldn't be as worried about an exit in a specific year. Where people should be worried about exit caps are these shorter term, bridge loan deals where they're banking on a big rent increase in a refi or a sale 2 years from now or 3 years from now. I think that's taking on a measure of risk that would be a little more than I'd be willing to bite off.
Got it.
We lock in that agency debt early.
Yeah. I've been doing my agency. All my deals has moved to agency. For past 2 years, I've stopped doing bridge loan just because of the exact reason that you are talking about. And I agree, bridge loan do have some risk. Some people like it because they think they can flip it, but you do not want to flip at the end of the age of the market downturn.
Yeah, and it can also flip the other way on you.
Yeah, flip the other way around. Exactly. So, it's, and also, bridge loans and turning around huge deep value add needs a lot of skills. And, you are really banging on the market timing right now, right? So,
yeah.
And there's a lot of factor to put in, right? It's like flipping a house, right? You're flipping an apartment, right? So is that how you started from beginning itself, where you have trained your investors to focus on the cash flow of the deal? And I have a lot of my investors now, they want like annuity. Just give me a cash flow. I don't really look at the pop at the back, and just give me an annuity, because 6 to 8% return cash flow is an awesome return, right? And it can be much more awesome during downturn.
Yeah. So how we work with our investors is, first we educate them on how we mitigate the downside, right? Why we do agency loans, why we lock in for a longer period of time than we plan to hold it. How are we, why we're buying a little bit newer of an asset versus what we were buying in different stages of the market cycle. Then we look at the yield of the property, and we look at with them, like you just said, look at this asset. If nothing else works, it's still going to yield 7, 8, 9%, right? And then we're looking at what's the potential upside down the road, and in that order, because people do want to see cash flow first, and they don't want to lose money, right?
Yep.
And it's nice to be in a situation where if the stock market is down 30% or it's 2008 2.0, we might not be selling anytime soon, but we're still going to be cash flowing, whereas other parts of their portfolio will be hammered.
Correct. Yeah. At that time, that 7 to 8% sounds really, really good return, right? Which is like you are basically getting it now, and you're just maintaining it throughout your market up or down cycle, which is awesome.
And it's harder, but that's why we look for deals that have that 7, 8, 9% cash flow very quickly, and we pay monthly on our distributions, is because I like monthly cash flow. I know you do.
Oh, absolutely.
And investors do too.
Yeah. But is that how, when you started like six units, 30 units, 35, is that how you were looking at the apartment?
No.
Perception of change?
That would have been 2010.
Okay. 2010.
2011. When I bought that property, it was bank owned, REO. So those were heavy value add deals. So early on, I was learning how to reposition a property, because that was the market cycle that we were in, the stage of the market cycle at that time. And so I started off buying those. I bought some C properties, some Bs, and we're looking for more of those heavy value add deals. And as the market changed, we changed with it.
Got it. That's very interesting. That's the part that I did. I did a lot of deep value add and, proven ourselves, right? Deep value add takes a lot of skills. Even value add takes a lot of skills. How fast to turn around, how you manage your contractor, how you manage your financial, how do you manage your scope of work and the schedule itself. It's very complicated, right? A lot of people could have done it by skill. A lot of people could have done it just because the market appreciated, not to say because they did the job itself.
And I'm sure you are excited for those deep value add deals to come back one day down the road. Mm-hmm. But today, a deep value add deal, we just underwrote one. There was a moderate value add, maybe $15,000 a door. And if everything went according to plan, we would make a 15 IRR.
Then what's the point of doing deep value add, right?
What's the point, right? Because I just bought a 1998 vintage deal that's fully occupied. And I just told you I raised rents organically already. and that deal is going to do a 17. And so there's so much demand, and there's so many buyers trying to crowd in and buy these so-called value add deals that we've gone to a different strata within our space to find value. And then when those value add deals get back up above a 20 IRR, I'll start taking another look at them.
Got it. So you have changed your strategy just because of the market cycle, and you think that is what the investors want,
Yeah.
and you still get there's a lot of investors who had even want like 3-4% return, right? So if you're able to give them 15% IRR or 17% IRR, they would be ecstatic.
Yeah,
So,
in my opinion, I've got to be mindful of the market and work within my marketplace. There's opportunities in every stage of the cycle, but you have to go right with the market, not against it.
Yeah. So how are you competing with big institutional players, because they look for this 1990s 2000, and
Yeah,
they'll be able to look at the same deals that you are looking at, right?
yeah, it's very hard. It's very hard. I'm very lucky that I started this several years ago, and that I've got a reputation and a track record with the biggest brokers in my region, which are all national brokers, and we lose a lot. We lose a lot to big guys. I just lost a deal yesterday for a deal. I loved it at 41 million, and some out of town buyers swooped in for 44 million, so they can have it. A lot of times it's off market, and then some of these submarkets that we're keenly interested in are off the radar of some of the bigger fish from out of town, and that's really how we're finding a lot of value. We know where the emerging markets are, the old Dave Lindahl approach, right? We know how to spot an emerging market, and that's a key to getting that value, and that's really, in my opinion, one of the only ways that you can get those returns up to where they need to be to continue to please your existing investors and attract new ones.
So let's go into details on how do you identify emerging market. Can you give top 3 things that you look for to identify this as an emerging market?
There's a lot to it. I'm lucky that I'm in an area that I want to be in, but we're looking at infrastructure improvement is a big one. We're looking at population growth, job announcements, path of development. So, example, in Indianapolis, I know where the growth is going. I know where the good submarkets are that'll be the big suburbs of tomorrow. Infrastructure is probably one of the biggest ones. For instance, we're buying in a market right now where they're building a brand new federal highway over the Ohio River. That is going to bring more jobs and more commerce, right?
Got it.
That's just a few of the nuggets.
I think the local knowledge and local connections, right? Just the local knowledge itself is just very powerful.
Yeah, but it's not as hard as people think to find. I mean, if you're looking at the entire map of the United States and you're like, okay, I got to find an emerging market, that's going to be tough, right? But if you can start to focus in on an area and say, okay, what's one rung out? Where's the growth going? Where are the new big infrastructure projects planned? Where are the good schools out in those areas? Where are people moving to? Where the housing starts, right? Housing brings commercial brings jobs, and jobs bring multifamily.
Got it. Yeah, it's very interesting, to see where is the path of progress, and just go and target that where the big fish is not really looking at, right?
And then if you're buying below replacement cost and you're doing it right, you should have a rental range that gives you an economic moat between what a new construction project would have to deliver, would have to charge and rent, right? So if I'm in an area like I told you about Greenfield in Indianapolis, I'm in that area, and right now my target reno rents are maybe $1,150, $1,175 target rents after renovation. If I know in that market that somebody wants to come in next door and their rents have to be $1,400 or $1,500 a month just to get a shovel in the ground, then I've got a decent defensive asset. So new supply in many cases for me isn't as dangerous. It's actually can be a good thing.
Got it. Got it. Yeah, that was my question because 1990 2000 vintage sometimes can be competing with the new supply, right? So
Yeah, it can. So you really got to make sure your delta is $300, $400, $500, $600 from especially if you're buying A minus like me. It used to be the difference between A minus and A plus was maybe $200, and now in a lot of markets it's 500, 600, 700, maybe 1,000. And so if you can figure out where to enter that market and have a large spread between you and new construction, you're much more insulated from A plus concessions, right?
yep, yep, got it, got it. So apart from getting good loans, because right now the interest rates are pretty low.
That's the
Apart
big
from
thing, man.
interest
It,
rate is low right now, and apart from the buy itself, right, you're probably buying at a certain price that you think you can hit the investor target, right? How do you do value add? I mean, what do you look for in this 1990s 2000 vintage an apartment? What are the biggest value add that you see that is your favorite?
oh, that's none of your business.
Come on, man, reveal the secret. I have to work hard on 1980s, 1970 property. I want to go to 1990. But what do you see? I mean, what are the things apart from the price, apart from the loan?
Well, listen, I'll give you a nugget. Okay, I'll give you a nugget.
Yeah, you can give
A
few.
lot of a lot of operators are spending way too much freaking money on unit improvements.
Okay.
Okay, and so we know how we because we're vertically integrated, because we're property managers and we know everything going on the front lines in the trenches. We know where we're going to get an ROI. We know that maybe granite countertops don't get us the ROI that really nice Formica does. We know that a yoga studio in redoing a 90s fitness center with new equipment and a little yoga studio is going to get us a much better ROI than stainless steel appliances, for instance. So it's just knowing your market. It's knowing really the ROI on those improvements and how they impact rent. And it's different everywhere you go, right? It's not like you can just take what I say and go do it anywhere. You have to know in that market what works.
So is it by doing market survey is where you look for? I mean, in terms of the
remember, we don't have to survey the market here because we're in the market. We manage the properties. We have leasing agents all over the Midwest that are giving us instant real-time feedback, right?
Yeah, yeah.
But but with that said, we shop our competition. So because we control our management company and we're part of the apartment association, it's a very tight family in the apartment industry. And we really hire from within most of the time because it's such a specialized job. And so my team can call anybody on any apartment project anywhere in the Midwest and say, hey, it's Kat from BAM. Can I shop you today? Right. Mm. And they do the same to us. And we all trade information on what's working and what's not. And that's really what's one of the really cool things about property management is we help each other. Right.
Yeah, absolutely. Absolutely. I mean, it is a very small
community. Now, here's what we do. We shop ourselves. We secret shop ourselves. We're very upfront with our competition when one leasing agent's calling my competitor and saying, hey, can we trade what's working, what's not? What are you guys renting for, right? But then we secret shop our own people, and they get scored on how they do by outside sales consultants.
So you talk about two things. One is the amenity, where certain amenity are desirable, where you can, raise rent because it's more desirable. The second thing you talk about efficiency within the pipeline of property management, right? So
nobody uses a gym, but it still sells people on renting.
I know. It's crazy, right? I mean, I've spent, right now I'm being more cautious about what I spend on a gym because I know people may not use it. So I know there's a gym.
Yeah, but it's the wow factor, James. It's the wow factor. Ooh, you've got a yoga studio. Maybe I'll do yoga now. Yeah. I've been meaning to do yoga.
I know.
A year goes by. I never did any yoga, but I rented from that guy, James.
And I see my property managers using the gym, not my residents. That's okay.
Culture.
You need everybody to be healthy, right? So
#culture.
So let's talk about amenities. How do you decide on which amenity is more attractive?
It's all a functional market, and it depends on what marketplace that we're talking about. But okay. So we're We will redo pool furniture. A bark park is an easy one to put in if it's not already there. We're typically redoing the gym. A lot of times we're redoing the clubhouse with new paint, new furniture, maybe a couple computers. Things that sometimes people never use, but just to give that wow factor when they come in, to be able to close them on living there.
So do you increase, we mentioned in the beginning, $100 to $150 per door just by adding amenities and better management, I guess?
Yeah, it doesn't always work out that well. And usually that 150 is coming from multiple areas. We're raising certain fees. So maybe the owner hasn't raised pet fees or water fees since they bought the property. I get bad reviews on my website because we raised water fees to market, but that's just part of it. It'll come from organic rent increases, which is where we're just raising the rent at turn. And then it comes from quick cosmetic improvements to the units on turn as well. Paint, countertops, maybe new cabinet hardware. We rarely ever take out the cabinets, maybe new switch plates, maybe some new flooring in the kitchen and bath. Very light improvements.
So among the things that you mentioned just now, what do you think is the most valuable improvements that, is the biggest bang for the buck that all your residents love?
Yes.
Which one? You mentioned like 5 or 6. Which one's the best?
I'm giving you more nuggets than I should, man. I feel so close to you. I feel like I got to tell you these things, but normally I'm like, keeping this to myself. It depends. Sometimes it's organic, right?
Okay.
We bought a couple assets where it was a big company. They owned 5,000 units, but they still ran it like a mom and pop, and they were like 20 years old. And they never raised rents. If people don't move out, they don't renew them and increase them. We do. Another property, it was the amenity package that really started getting more income. And other properties, it's all those things, and it's property by property, which one's going to move the needle the most. But typically you need all those components to get into that target rent, right? That 125, 150, 175, it's going to help you achieve your target returns over the hold period.
Got it. So yeah, that's very interesting. So let's go back to, whatever you mentioned just now, to the demand of the property, right, which is the residents, right? Do you think the residents in this 1990s vintage 2000 year bill apartment residents is harder than class C, 1960, 1970 residents? Harder to manage, yeah. More maintenance.
In some ways it's less maintenance. In some ways, but in other ways, the tenants can also be the residents. We don't call them tenants anymore, James. The residents.
Yes, exactly.
The residents can be more demanding, have higher expectations. So you've got to have the right people there that are used to managing that particular product with the income of the resident that lives there. Yeah, some people would misunderstand and think that A+ is easier because everything's new and shiny, and oftentimes A+ is extremely management intensive because of the expectations of the residents. In some ways easier, and in some ways not.
Yeah, someone told me, one of my regional manager told me that, A+ residents much more harder to manage because they have all this ego that they can pay. They expect a lot of things from the property management company, and sometimes their delinquency can be high because they said, I can pay next week, you don't have to really come after me.
Yeah, we find the collections are usually better.
Got it. So let's go to financing. So on top of agency debt, you also do HUD debt, right? And why did you choose some of the deals to be under HUD loans?
HUD's a great way to take a ton of risk off the table. It's 35-year amortization, and it's full AM, meaning you can hold that note for 35 years without having to refinance or sell. So you take a lot of risk off the table. The interest rates are somewhat lower, although Fannie and Freddie have gotten very competitive in the last couple of years. It allows you to get 85% loan to value on after repair value, so you can finance a lot of improvements as well, which is great in some circumstances. So it's if you want to hold a deal a while, like 10 years or more, HUD can be a good alternative. It's also very compliance heavy. There's audits, there's physical audits of the property. So you really have to know what you're doing. We like it just simply for risk management. So we have several assets that are HUD. Big myth is that HUD means it's an income subsidized project, and that's actually incorrect. HUD finances A, B, C, D assets. Their mandate is to help provide rental housing. So it's available to a lot more people, a lot more assets than people may recognize. Certainly not for everyone, but in certain circumstances, I think it's advantageous. We locked in our last HUD deal November of 2018, $34 million deal, locked in with HUD. Our all-in note rate is 313.
Wow.
Yeah. Yep.
And I remember November 2018, the interest rate actually for agency debt was pretty high because I did lock in some deals at that time. And I think November, December is when it picked up and it came down again. So
yeah, it was lucky. We were able to catch the bottom of that treasury dip, which helped.
yes.
But it was still lower than agency.
So how do you do? I mean, I know HUD has like a 6 months once distribution, right, where you can take out the money. How do you do distribution to your investors when you have that kind of limitations?
That's one of the downsides of HUD. You can only distribute every 6 months. That's why we don't use it very often.
Okay.
Yeah,
So,
it's a different investor profile. Some investors, they want to be defensive. They want to have their money in something, and they want to have leverage, but they want to have downside protection. So HUD works really well, but it does not provide the same sort of cash flows that agency and Freddie do, which is why we typically use the agencies. For instance, I think I said earlier with our fund, it distributes monthly. I couldn't do that with HUD.
Got it. Hey, Ivan, let's go to a personal side of you, right? I mean,
yeah.
Why do you do what do you do?
For me, multifamily and growing BAM as a business is a lot of fun, because the bigger it gets, the more fun I get to have. And it's a great business for designing the life I want and designing the business in a way that fits into the life I want for myself, my wife, my family. And so I like the wealth and the freedom with real estate. Yeah, that's the crux of it, James. I've got some big goals in being a good dad and a good husband and a good member of my community and leaving behind a legacy. And for me, owning real estate and owning a business to operate it is the path.
Would you do this for another 20 years?
It's funny. I got to sit down with an older guy on the banking side of our business of multifamily. Took his bank public. I don't know what he's worth, but it's over $500 million. He's probably approaching 70. And he says, Ivan, you don't stop. You just play the game at a higher level. And I can tell you, he's having a lot of fun, has a lot of freedom, has a lot of time with his grandkids, travels wherever he wants for as long as he wants with whomever he wants. So I don't see myself retiring in the traditional way. I want to continue to just play the game at a higher level.
Yeah, it is so fun, right? To keep on improving things and
yeah, and I like to tell young entrepreneurs this, and people that are newer to the business. If you're getting bigger and you're not having more fun, you're not doing it right, and you need to refocus on your people and your process, and so that you can scale it, right? Because none of us can just keep working harder. It's unsustainable.
Correct. Yeah, that's one of the challenges that we are having, and we are trying to grow. And it's becoming harder to find that process and people, especially, right, to replace what we do. And we have certain expectations.
People are the key.
We have certain expectation on how things should be done, but not everybody is gonna work like what we do, right? And we have
the first coach I hired 4 years ago, all we focused on was figuring out what my one thing is that if I spend most of my time on that, I will be successful, and then finding the right people to do everything else. And then the hardest part is from a guy that started myself and did everything myself. The hardest part, but the key is getting out of their way once you hire them.
That's really hard. And you're
yes,
right. This is the hardest part. So
I think Tim Ferriss said it best, James. He wrote some articles about letting little bad things happen. Mm-hmm. And that's key. Excuse me. I thought I was going to sneeze. Learning to let people make mistakes, even when it costs you money, and letting them learn and fail forward, just like you had to do, is very freeing. And when you have a management company and you've got fees coming in every month, it becomes a little bit easier to start to let those little bad things happen, let people fail forward, let them learn, and make sure they're not just coming to you for the answers all the time.
Got it. Yes, the art of delegation and managing people. So, it's just so hard to master, right? So,
well, if you get the right people, there's far less management.
Absolutely.
You get the right people in the right seat. That's a big part of it.
Yes, I agree with you. Let me ask you one more thing. You started from 6 units to now almost 3,000 units. You have gone through a lot of experiences. Tell me one proud moment that you can never forget, that you were really, really proud of yourself, where you think, this is something I will never forget throughout my life. What is that moment in your real estate career?
Oh, so real estate category.
Yes. Something related to real estate, right? So
yeah.
Real estate, family, anybody. It's just a human interaction, right? What was that proud moment where you think that I'm very, very proud that I did this, and I can never forget this until the day I die?
So it was our first, one of our first bigger deals. But it was only 89 units. I think I bought that one after, right? I bought. Yeah, it was. I bought
units, one. Absolutely.
Well, I had bought 112. I already bought 112 units. And so I almost passed on this deal. It was only 89. I'm like, do I want to do a deal that's only 89 units? And it was in kind of a rough area that was starting, we thought was maybe emerging. We kind of looked at each other and we were like, my partner and me, like 6 months ago, this deal would have been huge for us. Why are we turning our nose up at this deal? We should do it. And we did the deal. We got it at a good price. And people thought we were crazy, and it was a little bit difficult to raise the money. And we bought it from a construction guy that had already done all the heavy lifting on the value. So people thought, right? What's left to do, because this guy already improved it physically. But we had this suspicion that we could manage it better. And 2 years later, we sold it for almost $2 million more than we bought it for. Ended up selling it at a 2.5x to our investors in 2 years, a little over 2 years. And that was my first really big home run. And I remember thinking, gosh, we almost didn't even do this deal.
Yeah. So what did you guys do in that deal to make that much money, since it's already done?
We got a much better manager in place.
Okay, management.
We got a really good maintenance guy in there, and of course we asset managed them. And we were able to raise rents. We got occupancies up. We reworked the utility bill backs to make more revenue there. So the cap rate on that one didn't compress all that much on the sale. It wasn't just like the market went up. We just got in there and turned around the NOI, because this guy was really good at making all these physical improvements, and he was a terrible manager. And so we got all that straightened out, and a couple of years later had a big win to show for it.
Awesome. Yeah, I remember my third deal was like that. Everything's done well. I was trying to find out what's wrong with this deal, and it was a smaller deal from what I used to do.
Yeah,
I'm trying to really analyze what's wrong. Something is wrong. But it went in and out of contract like 5 times, and the seller was really frustrated. So he wanted someone to close it. So that's where I came in at that time. So Ivan, why don't you tell our listeners on how to find you, how to get hold of you or your company?
I'm all over the internet. The easiest way to find me and my team is probably ivanbarratt.com, Barratt. If you Google Ivan Barratt, Barratt, you can find ivanbarratt.com, Barratt Asset Management, Ivan Barratt Education, which is a site I put together for accredited investors, but they all cross-pollinate. So you find one, you'll find them all. I'm all over LinkedIn. And then if you want to talk, 317-762-2625, 317-762-2625.
Man, is that your cell?
Yeah. No. That is my scheduler. My scheduler will promise to get you on the phone with me.
That's going to be, I was surprised. It sounds like a cell phone, but it's not. But awesome, Ivan. Thanks for coming over. Hope you enjoyed it. And I'm sure
I had so much fun, man.
I learned so much from you, and I'm super happy to know you. And thanks for coming in and had value to the.
Yeah, I'm sorry to miss you in New Orleans. I can't make it, but I'll see you at the next one, dude. I always enjoy our conversations, and I gave my banker a ton of crap thanks to you. I appreciate that.
Oh, yeah, absolutely. I gave you that tip, right?
Yeah.
Awesome.
Oh, yeah.
All right. So thank you.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.